Diamond Standard is the first regulator-approved diamond commodity, and it looks like this.
Since the COVID shutdown, the market has continued to grind higher. Some of the best opportunities of our lifetime are now emerging. We've gathered experts from a range of sectors, and we wanted to ask them why we should invest in them and why now. In this episode, we'll be talking about diamonds, and in particular, a company that is revolutionizing the diamond market.
This really is something brand new. It's a brand new commodity that's never been offered before.
For the first time ever, diamonds are available as a fungible liquid commodity.
I think that it's just an ideal use case as to why digital assets are so important.
Each diamond is different from the one next to it. And while there have been a lot of discussions and thoughts about commoditizing the diamonds for financial markets, no one's really ever solved the problem of fungibility, being able to make one commodity unit equal to the next commodity unit.
The breakthrough is that these two bars, even though the diamonds may be different inside each bar, we can prove that these bars have equal value based on the geological content.
I think there'd be quite a lot of interest in another hard asset, a known commodity with a long price history, and one that, if it's accessible through exchanges, I think investors would view this as a great natural hedge.
So it's certainly something which I think is going to be revolutionary.
Prices of gold, silver, and Bitcoin are rising in the face of fiat money printing. So how does that affect diamonds? Historically, diamonds are for just retail investors, but a recent breakthrough in blockchain might lure in institutional investors. I wanted to understand why that spike in demand might happen and why now is the time to invest.
In a world where there's unlimited money printing and huge volatility in asset prices, having a hard asset is very important right now.
But I think it's been remarkable that we've been in a period where central banks, especially the Fed, has grown its balance sheet, printed a lot of money, and we've had a huge increase in money supply, M2. And yet interest rates have been really benign.
I think historically we always see interest in diamonds alongside the broader interest in hard assets and alternative assets when there are these types of dynamics of governments printing money, expected inflation. Diamonds do perform well in that environment. I do believe there is increasing demand for diamonds from players across the spectrum, not just wearers and users of the jewelry, but also people who are coming at it from an investment perspective.
Diamonds are near a 10-year low, and it's not because of demand. Actually, the supply of diamonds is very constrained. There's been no new diamond mines of any note discovered in the last 20 years.
Supply is essentially governed by a small number of diamond producers, those that remove the diamonds from the ground and then sell rough diamonds into the marketplace. If you then layer on top of the fact that there was 3 months of mine closures, the immediate term supply is somewhat restricted.
Macro tailwinds, a restricted supply. What is the potential size of the institutional demand, and how does that fit into their portfolios?
Diamonds, it turns out, are a massive natural resource, accounting for 1.2 trillion of above ground value, which is second only to gold. And they're orthogonal, which means their return is not correlated to stocks, bonds, even other commodities, and even gold. And as such, it's a very, very valuable asset, especially for institutional investors.
The way that we're rolling out the product is very similar to the way hedge funds were rolled out. Initially, it's going to be mostly for high net worth individuals and family offices, maybe some sovereign wealth funds, private banking clients. And that's really going to be the first phase of the launch of the coin and the diamond bar.
That demand for diamonds, we think, will be 180 billion, which is 15% of the above ground supply.
And then second is going to be the mutual funds, the pension plans, the foundations and endowments, the more sophisticated institutional investors who are going to need to see some type of liquidity event in the marketplace with the diamond bars and coins.
We've solved all of the constraints that prevented diamonds from taking the place next to platinum, palladium, rhodium, silver. If you look at all of those other precious metals, at least 15% of the above ground supply is held by investors.
When people first invested in hedge funds, there was no asset class. I mean, alternatives at that point really consisted of real estate, private equity, timber, like things like that. Hedge funds weren't even really an asset class. Here, in the case of Diamond Standard, you have an existing kind of asset class in precious metals. And I think that's also another really big thing about us is that we are regulated, and hedge funds really weren't in the beginning. And that was a very big risk for institutional investors. This is actually regulated in Bermuda.
What we want to be is not only a home for, I would say, digital asset companies, but companies that are going to be pioneering new age finance based on digital assets when it comes to banking, et cetera. So that's going to be the next step of our evolution. I think that it's just an ideal use case as to why digital assets are so important. Because they allow you to do things that you were never able to do beforehand in a safe way.
This is an exceptional idea that solves the fungibility problem, that creates a standard unit in diamonds that the financial markets can get behind and build products around.
Gold right now is approaching a 10-year high. Diamonds are actually at a 10-year low because diamonds were never available to institutional investors. Diamonds, we think, will catch up with platinum, for example, as a store of wealth in institutional portfolios. Investors own about 15% of the world's platinum. So that brand new demand in an asset that has an extremely constrained supply is likely to make prices go up.
You could easily see a $100 to $250 billion investment landscape for diamonds as a commodity.
Gold bars, silver bars, and now fully fungible diamond bars.
For the first time ever, diamonds are available as a fungible liquid commodity that's traded on spot exchanges. Every coin and bar has the same value, so it has the same price. That commodity allows institutional investors and individual investors to hold diamonds, mark them to market, sell them with very little friction, and use diamonds as a liquid store of wealth for the first time. We've already developed arrangements to list the spot commodity on a digital exchange. We're listing a futures contract on the CME Globex. We're listing an options contract on the MIAX Options Exchange, and we're listing an ETF on the New York Stock Exchange in partnership with premier asset managers. It's a breakthrough digital asset. Because of the computer chip that's built in, consumers can transact with the blockchain, and this asset, it allows a new world of asset-backed digital products, including a multi-blockchain currency. That initial offering is coming up in September, and anyone can place an order at diamondstandard.co.
Hedge funds were once an alternative asset, and now they're commonplace in the industry. Diamond Standard is trying to do the same exact thing, opening up a whole new asset class for institutional investors. If you haven't investigated diamonds, now might be the time to do so.